Welcome to today's Explainer. We're jumping right in to break down an absolute game changer in the banking world, Banco Santander's massive acquisition of Webster Financial. We're going to cut through all the noise today and look exclusively at the verified financials. Our goal, to map out exactly what this huge transatlantic leap means for the long-term investment thesis. You know Santander, right? For years, they've been this absolute global powerhouse. But realistically, their core identity has always been fundamentally tied to their massive presences in Europe and South America. Meanwhile, their footprint in the US definitely lagged behind their major peers. Well, that legacy identity is officially pivoting. By acquiring Webster Financial, they aren't just expanding, they are stepping firmly into a brand new role as a true heavyweight right here in the United States. The sheer scale of this shift, it's honestly incredible. Getting the final green light from the Federal Reserve means this is not just some minor portfolio tweak. No, Santander has officially vaulted into the top 10 banking ranks in the United States. This fundamentally transforms their entire global footprint, and it completely reshapes how the market has to evaluate their structural growth potential going forward. Now, as you might guess, buying your way into the top 10 is definitely not cheap. To make this leap happen, Santander front-loaded a massive €3.56 billion capital increase. And the strategy here was totally deliberate. By raising this capital before the deal even officially closed, they secured their balance sheet, they kept the regulators happy, and they proved to everyone that they aren't over-leveraging the bank just to pull off this transatlantic expansion. Okay, so here's our agenda for today's Explainer. We'll cover 1. The price of scale. 2. The U.S. strategic rationale. 3. Rewarding shareholders. 4. Execution risks. And 5. The bottom line. Let's get right into it. Section 1. The price of scale. If we dig into the official SEC and Spain's CNMV filings, we can see exactly how they engineered this whole thing. Santander didn't just do a simple stock swap. Back on August 21st, they proactively issued nearly 330 million new shares. That represents about 2.2% of their total share capital, priced at €10.78 per share. Like I mentioned, this was all about pouring a totally secure foundation before bringing Webster onto the books. But there is a short-term price to pay for this rapid expansion. Let's talk about the Common Equity Tier 1 or CET1 ratio, basically the absolute gold standard for measuring a bank's resilience. They started the year exceptionally strong at 14.4%. Post-acquisition, though, management is guiding this down to a range of 12.8% to 13% by the end of 2026. The crucial takeaway here is this temporary digestion period. Absorbing Webster's huge asset base is naturally going to dilute their capital density for a bit, pushing them to the lower end of their internal targets. But again, it's planned, it's transparent, and it's well managed without taking on reckless leverage. Moving right along to Section 2, the U.S. strategic rationale. So why do all this? Well, it really comes down to two things: revenue diversification and deposit stability. Webster operates heavily in the U.S. Northeast, which brings Santander a highly stable, low-cost, sticky deposit base. Why does that matter? Because it drastically reduces their reliance on volatile wholesale funding. In fact, it's such a strong move that S&P Global actually affirmed Santander's BBB+ rating specifically because of it. On top of that, management has locked in a hard target of $800 million in annual pre-tax cost synergies by 2028. They're doing this through massive scale and major tech integration. In the banking world, scale literally equals efficiency. By absorbing Webster's commercial lending base, which, by the way, is way less sensitive to interest rate swings than pure consumer finance, Santander is targeting a massive jump in profitability. Before this deal, their legacy U.S. business was sitting at a return on tangible equity of about 10%. By 2028, management expects to nearly double that to a highly impressive 18%. All right, Section 3, rewarding shareholders. This is probably the part you've been waiting for. So, what's in it for you? The short answer is quite a lot. Santander remains exceptionally generous to its investors, especially considering we're in a fairly low-growth European macro environment. Management is committing 50% of their total group profits directly back to shareholders. This is heavily weighted toward a cash dividend payout of roughly 35%, while the remaining 15% goes to share buybacks. And here's the kicker. That cash dividend per share is expected to more than double compared to 2025. And it doesn't stop there. Management is signaling huge confidence in their post-acquisition cash flow. They've officially committed to at least €10 billion in share buybacks over the 2025 and 2026 earnings cycles. Think about that for a second. Even while swallowing a massive acquisition like Webster, their cash generation is so robust they're planning to buy back roughly 10% of the entire company in just 2 years. They are aggressively offsetting that near-term capital dilution we talked about with an incredibly well-capitalized return strategy. But we've got to look at the whole picture. Section 4. Evaluating the execution risks. The reality is, the single biggest execution risk facing Santander today is the physical integration of Webster. The final core systems conversion isn't actually expected to finish until the tail end of 2027, so we are essentially stuck in a multi-year holding pattern. The real danger here? Client attrition. If Santander loses key commercial clients during this incredibly complex multi-year systems conversion, those $800 million synergy targets we discussed are simply going to miss the mark. You also want to keep a really close eye on the bank's cost of risk. It's currently sitting at 1.15%, and this metric basically represents the bank's provisioning for bad loans. Right now, this is mostly being driven by provisions over in their UK motor finance division. But if the US economy hits a soft patch or dips into a recession, those provisions could absolutely spike, and that would act as a hard ceiling on the profitability of all these newly acquired US assets. Which brings us to our final takeaway, Section 5. The bottom line. Even with the reality of short-term capital pressure and those integration hurdles looming in 2027, the market is absolutely buying into management's vision. The stock is already up roughly 25% year-to-date. Analyst consensus is sitting firmly at a buy, with average price targets right around 13 euros. And the grand finish line for all of this is 2028, where Santander is targeting an unbelievable 20 billion euros in total profit and a massive 20% return on tangible equity. So, what does this all mean? Santander is officially no longer just a European bank with a Latin American flavor. They are a true transatlantic heavyweight that has successfully bought its way into highly profitable U.S. scale. The long-term upside looks genuinely substantial for growth-focused income investors, especially with those robust dividend and buyback programs locked in. So, considering the massive synergy potential weighed against the risks of a multi-year integration, we have to ask, does this newly minted U.S. banking heavyweight deserve a spot on your watch list?